20 dumb money mistakes you must absolutely avoid in your 20s. A lot of stuff happened in your 20s, but if you don't pay attention to your financial situation during that decade, you'll end up regretting for the rest of your life. Avoid these 20 money mistakes in your 20s so you can set yourself up for financial independence later on. Welcome back, folks, to the another edition of the Sweetie Kiwi Show. I'm very happy to have you today. I hope you are doing fantastic. I'm doing marvelous, if you were to ask. And if you're doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. Today we're going to talk about 20 dumb money mistakes you must absolutely avoid in your 20s. Number one, not taking care of your credit. Now, credit is very important. You got to build your credit history, right? Because this decision impacts other areas of your life. You know, if you want to rent an apartment, if you want to apply for a credit card, you want to get a loan, all kinds of stuff. Even when you want to get insurance, the insurer will check your credit score. So it's very important to start now because it takes a lot of time to build a good credit score. So what you want to do is you want to start practicing credit-worthy habits, right? Such as making your payments on time, and try, very importantly, not to open many accounts at once, right? So you're trying to probably have 2 or 3 credit cards, and also keep your credit utilization as low as possible. Now, credit utilization is the amount of credit you use as compared to your limit. So, for instance, let's say you have 1,000 credit card limit and you use 200. That's a 20% credit utilization rate. This is very important. All right, try to pay your credit cards monthly, and don't carry a balance of no more than 25% or 30%. Number 2, failing to set financial goals. Now, it's very important. If you fail to plan, you plan to fail. This applies also when it comes to finances. If you want to build wealth, if you want to build some kind of wealth and achieve financial security in the long run, you got to plan. These things don't happen magically. It takes a lot of planning, perseverance, and patience. So you need to have financial goals very clearly, right? Again, when it comes to goals, I like the word SMART. You want to have SMART goals. SMART stands for specific, measurable, attainable, realistic, and timely. So you want to, for instance, you can say, what? I want to have a $1 million worth in my bank account worth of disposable assets by the time I hit 30 years old, right? So you just can't say it. You have to put in place all the elements, all the processes that will lead you to be millionaire by 30, right? So if you're 20 years old or 21 years old and you want to get $1 million in your bank account as disposable cash in the next 9 years, you need to plan that, right? Number 3, not seeking ways to make extra cash. It's very important that if you are a 20-year-old or 20-something-year-old, you want to take advantage of your free time to earn extra cash, right? The thing is, when you're in your 20s, you have a lot of energy, you have passion, you have commitment, you have a lot of vigor. Those things will decline as you age. So you might as well just take care of it right now and engage in 2 or 3 side hustles that can bring you extra cash. Number 4, living beyond your means, right? Never spend more than you earn. This is very important. Live within your means, month after month, quarter after quarter, year after year, right? This is as simple as it sounds, but believe me, it's not easy. So you have to find a way to inculcate this practice, this principle into your daily life. Live within your means. Number 5, non-monitoring your cash. It's very important to track your cash. You want to look at, on a monthly basis or on a quarterly basis, depending upon your situation. What you want to do here is, gather your bank statements, your credit card statements. And if you are good with Excel, you can set up a quick Excel spreadsheet that tracks your expenses. This is kind of like good for budgeting also. And by doing that on a monthly basis or every 3 months, you're able to identify areas where you spend too much and areas where you need to save, right? So this is very important. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We're still continuing our conversation around the 20 dump money mistakes you must absolutely avoid in your 20s. If you like the content, clarity, and quality so far, consider subscribing to our channel and turn on the notification bell. Really appreciate that. And also like this content, share. It's very important. We want to share this kind of content so everybody knows how to save, especially those folks who are in their 20s or 30s can know how to save and properly plan their money, properly manage their money. Also, comment below, let us know your tip if you have advice to a young listener or viewer, some of the things that he or she should do. All right. Mistake number 6, paying off the wrong debt first. Now, it's very important. You have to understand there are what I call productive debts and non-productive debts. So you don't want to pay your productive debt first. What do I mean by productive debts? Student loan, right? Home mortgage, car loan. Those are very important. Those are productive debt because those are debts that allow you to acquire an asset. Right? When you have a student loan, you are investing in your career. You're investing in your education. That's a good debt. Right? When you buy a house, you are investing in real property. That's a good debt. So what you want to do is you want to start paying off the wrong debts, the bad debts. Right? So you want to, credit card, if you use a credit card for groceries or for travel or for a wedding, that kind of stuff, you want to pay it off first because it's not a good debt. All right. Not taking calculated risks. If you're young, this is the time to take calculated risks. You want to explore the world. You want to go out there and give it your best. By the time you turn 30 or 40, there are certain risks you can't take anymore, especially if you are in a relationship and you have children. Your risk-taking propensity will have to decline. That's just the way things are. It's not about you or anybody else. That's life. So now that you're young and potentially single, you want to take advantage of those things. So if you get a job in a new city, they want you to relocate. Let's say you live in New York and they want you to relocate to California, to LA or San Francisco. Do it. Right? That's a good calculated risk. You want to also you want to further your education. You can try to obtain a master's degree or obtain that very prominent certification that you need in your industry to move up the ladder, or invest in the stock market. Right? Those are calculated risks. Of course, when I'm talking about buying stocks, I'm not asking you to buy shares in a very obscure company. Buying the stock of, say, Google or Amazon is a calculated risk because those companies are not going anywhere. The risk of them filing for bankruptcy is very, 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 very remote. All right, so that's the kind of stuff you want to think about when you want to take a calculated risk. Now, number 8, borrowing to fund a premium car. Everybody loves driving luxury cars, right? But the idea is, if you like luxury rides, you got to make sure you can afford it. And the worst mistake you can make is to, borrow to fund that lifestyle. You are essentially living beyond your means, which is what I talked about earlier. And you don't want to do that because the thing here is that you are actually robbing yourself of future earnings. Number 9, living off credit cards. Now, again, this sort of harks back to the comment I made about living beyond your means, right? Why would you want to live off of credit cards? I mean, we see this a lot. Research has shown this a lot. You go to the restaurant, you travel, everywhere you use credit cards. This is really bad because not only is it a sign that you are living beyond your means, it also means that you're not actually thinking about your debt management. You are just racking up debts, and you're not, unless you're paying off everything at the end of the month, unless you're paying the full balance at the end of the month, this is a bad strategy to start with. All right. Number 10, borrowing to pay for a wedding. right? So let's say you're ready to tie the knot. You found your significant other. You've made the statement, till death do us part. So you're very comfortable. So you just take debts. You borrow to finance the wedding. Now, this is a bad debt. This is not a productive debt. Don't get me wrong. Investing in your relationship is great, but investing in a relationship where you just get into the relationship, you haven't seen the relationship mature, being fruitful, go through ups and downs. This is a bad thing. We live in a society where divorce rates are as high as possible. They have been the highest ever. So you never know. I mean, people divorce after 3 days, after 3 months. I'm not saying that, your relationship is doomed, but what I'm saying is you want to be realistic when it comes to using cash for your wedding. You can invest in a house later on, and that's a productive, because the mortgage is backed up by real property, but the marriage is not backed up by anything. It's not an asset. All right. So this is not a good decision. I will be right back right after this. Do not go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. I hope you are doing fantastic so far. And we're still talking about the 20 dumb money mistakes you must absolutely avoid in your 20s. Mistake number 11. Not saving for retirement. This is very important. When you're young, you think everything is great. You think you can live forever, but life is unpredictable. And what you want to do is you never put off saving for retirement, right? You want to start taking advantage of every possibilities out there in terms of individual retirement accounts, IRAs, to traditional IRAs, Roth IRAs, 401ks, all of this stuff. The earlier you start, the better. Because these things not only compound, the amounts in your portfolio not only compounds and increase over time, your employer, your company also matches. So in other words, if you're contributing, say, $3,000, your employer might also match $3,000. So that's $6,000 in your account. So that's a lot of money, especially when you're in your 20s. By the time you retire after 40 years, imagine how much money you'll have in your account. So that's very important. Do not put off saving for retirement. Number 12, not buying renter's insurance. Now, what is renter's insurance? Renter's insurance actually literally just protects you against any unpredictable adverse events happening to your belongings or to the property that you rent. This is very important because a lot of young folks think this is a waste. That kind of insurance is a waste until the unexpected happens, right? Remember that, if you have a fire or a flood, something destroying all your belongings, or you have a break-in, somebody just robbing you, you need money to replace essential stuff. And that's what the renter's insurance is for. All right. And the premiums is very, very low depending on where you live. So it's a good risk reward ratio, if you will. Number 13, not talking about money with your partner. It's very important when you're in your 20s and you start your first or your second relationship to discuss financial matters with your significant other. If you're going to be living with that woman or man for the next 20, 30, 40 years, you want to engage in conversation that matters from the get-go. You want to have an understanding around what matters, around spending patterns, around savings schedules, around retirement, around children. There is a whole host of topics that you need to have when it comes to having what people call the talk. And this thing, that talk, that conversation around money, I would suggest you have it as frequently as every 3 months. So you want to have it as often as every quarter. It's very important. It could be only a 20 minutes or 30 minutes conversation, but it allows everybody to be on the same page when it comes to money, right? When it comes to dealing with big purchases, when it comes to investing, when it comes to saving. Number 14, not setting up a rainy day fund. Now, it's very important to have an emergency fund. And what you want to do is you want to have a savings fund, a normal savings fund, right? That you kind of you know, you kind of tap into when you need it, right? But you also want to have a rainy day fund, and that fund is a fund that you only choose, you only tap into when absolutely necessary. And what you want to do is you want to do the savings automatically. So you want to automate the savings. So if you're working, you can set 5% or 10% of your savings to automatically 10% of your salary, rather, of your paycheck, to go automatically onto that emergency fund, right? So you just forget about it, the money just takes care of itself, and that's it. And you can even transform that emergency fund into a CD, so you can collect some kind of a little cash from interest every now and then, right? So you can open a money market account or a CD, a certificate of deposit, so you make the money. Number 15. Now, it's very important. Before I talk about number 15, the rainy day fund is important for unforeseen circumstances, right? So let's say you lose your job, or you have like a huge your car has a repair bill that's very huge, or God forbid you have an accident and your medical insurance can cover everything. You have that money for it. All right. So number 15, spending carelessly. This is the kind of stuff that a lot of folks in their 20s take very lightly, but you shouldn't. Don't spend carelessly. For instance, you have a lot of folks that have their closet stuffed with things they rarely use. They just want to buy during the holidays because of things that are supposedly on sale, quote unquote sale, and people just buy stuff they don't absolutely need. And the bottom line here is that you have a pattern of careless spending over and over and over. You want to stop that habit if you're currently on that path, because it's a waste of money, and this basically will just this will reduce your wallet, reduce your wealth management plan in the future, right? Don't go on those random shopping sprees, always trying to make a grocery list, right? So you can pack your lunch, you can know absolutely what you're trying to buy. You can try to limit your online shopping also, right? Because all of those random purchases add up. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We're still continuing our conversation here. So number 16, not buying health insurance. It's very important. Health insurance is critical, and if you have it through your employer, that's fantastic. If not, you want to get private health insurance. When you're young and vigorous, you might think that you're going to live forever and that you will never be sick. But the thing here is that, if you have an accident, God forbid, if something happens to you and you have a medical emergency, the cost of that emergency, the cost of treatment can quickly add up, and you might actually find yourself, facing a huge bill that could make you go bankrupt. You're right. So you have to really think about those things. Even a small trip to the ER can really leave a dent in your wallet. So you want to get medical insurance rather. Number 17, starting a family without a proper financial plan. Right. It is important that children cost money. It's very important to remember children are adorable, they are sweet, they're everything, but they cost money. I'm not even talking about the food. I'm talking about maintenance. I'm talking about tuition. I'm talking about kindergarten. I'm talking about daycare. I'm talking about a whole host of expenses you have to plan. You can't just let it happen as if like it just happened out of a blue moon. No, you got to plan those things. So before you start a family, have a proper financial plan. All right. Number 18, telling yourself financial lies. Right. So basically, let's say that you basically live in illusion, in a dream. You avoid looking at your credit card statements or your bank account statements, right? Because you basically believe that everything is fine. Again, this is very important. If you remember earlier, I talked about having a plan, and if you don't have a plan, you're gonna live in that la la land that is just really bad for you, and nobody wants that. Starting with you. You want to get to a point where you look at things very objectively, you look at things reasonably, and face challenges head on. You want to face problems head on. All right. Don't fall for that thing where people, for instance, right now you are living beyond your means, and you keep hoping that by the time you get a raise, by the time you get promoted, everything will be fine. No, don't plan your life based on the future. Plan your life based on the situation today. So do not tell yourself financial lies. Number 19, not paying down your student loans early. The last thing you really want to avoid, allowing college expenses to balloon. Right, when it comes to student loans, because student loans are growing up, you could actually start paying them. You don't have to wait until you graduate before paying them. You could pay them while you're still in college, if you're able to trim other aspects of your life when it comes to cost. What I'm trying to say here is that there are a lot of stuff that you can reduce when it comes to expenses while in college. I'm talking about those late night trips to the bar. Those excursions, they're not necessarily important, or the frivolous and careless spending on those random shopping sprees. There are a lot of stuff that you can really reduce, so that you are able to have some cash and start making a little bit here or there, to start making a small payment to your student lender every single month before you graduate. That way, you are reducing also the interest being accumulated on that loan. Now, mistake number 20, not monitoring your credit score regularly. It's very important. I said earlier that, building credit is important, but you also have to monitor and track your credit scores, right? Because you want to understand your overall financial health. So, for instance, if your score is poor, let's say in the 300s or the 400s, we have a problem. You have a problem, so you can start taking mitigating steps to counter that. By contrast, if you find that your credit score is in the 800s, then that's perfect. That's a motivating opportunity for you to keep doing what you're doing, right? So you want to constantly track those things to know where you're staying when it comes to your finances. So credit scores are very, very important. Don't go anywhere. I'll be right back right after this. All right, folks, we have been talking about 20 dumb money mistakes you must have absolutely avoid in your 20s. If you love the content of this show so far, please consider subscribing to our channel and turn on the notification bell so you can be notified whenever we drop a new show. Also, comment below, share this content, and most importantly, like. Now, I'm going to recap today's show. Here are the 20 mistakes. Not taking care of your credit. Failing to set financial goals, not seeking ways to make extra cash, living beyond your means, not monitoring your cash, paying off the wrong debt first, not taking calculated risks, borrowing to fund a premium car, living off credit cards, borrowing to pay for a wedding, not saving for retirement, not buying renter's insurance, not talking about money with your partner, not setting up a rainy day fund, spending carelessly, not buying health insurance, starting a family without a proper plan, telling yourself financial lies, not paying down your student loans early, not monitoring your credit score regularly. Now, there are a few other things I want you to pay attention to, and this is today's call to action. Now, don't rush to buy a home. If you're in your 20s, try to resist until you're really, 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 really ready. Everybody thinks you got to have a house, you got to have a home. No. As a matter of fact, I know a lot of folks who are in their 30s or 40s and they still don't have a car. Everybody's situation is different, that's for sure. But you want to buy a house only when you're ready, and most importantly, try to buy with your significant other. So you want to be in a relationship, in a serious relationship. Even better, you want to be married before buying a house. The second thing here is that don't go to grad school just for the fun of it. Everybody thinks, oh yeah, you got to have that MBA or master's degree. Necessarily, you have to think. You have to ask yourself: does this degree, does a graduate degree, fit my career path, fit my industry? In some industries, maybe having a bachelor's degree and a few professional certifications and licenses, is way better, is way more appealing to employers than having a master's degree or a doctorate degree. All right, so think about that. Another thing you want to avoid is don't give up on a chosen career. If you have a career that you love and things that you want to pursue in your life, go for it. If they're asking you to relocate to pursue the career, do it. Right? This is the time to do it. This is the time to explore those career options. And most importantly, which is the last thing I want you to do, is to try to be independent. Don't lean too much on parents. You need to learn. You need to learn to start living on your own. Of course, it's important, and you have to be grateful and thankful that your parents are still alive and they are able to support you morally, psychologically, financially. But it will come a time where you have to fly on your own, right? So, mommy or daddy won't be around. So you want to start learning that now, and do not abuse the generosity of, the parental generosity. All right. I will see you next time. Good luck. And until then, stay marvelous.